email query now. Rupashri Chaudhary is written in. She says that she and her husband have jointly purchased a home. Now, they are joint owners. The interest amount of the home is 5 lakh rupees. It is Rupashri's first house and the second house for her husband. Now, she wants to know how they should distribute ownership to save maximum tax. Does it really matter when they
this query is fairly complex and I might need a little more time to answer this. First of all, it is not clear whether who is the, whether this is a joint property, both have contributed or only one has contributed, whether the property has been given on rent or otherwise. However, let me take a simple example. I'm assuming that both of them are 50% co-owners.
They're saying joint owners, so I'm guessing that that's what they mean by that.
No, but joint ownership does not mean co-ownership. You may just add in the name of a person and the person can become a joint owner. Whereas when you say that you are a co-owner, that means you are actually contributing the amount towards the cost of the asset.
Okay.
Okay, so I'm assuming that both of them have contributed equally. Now, taking that presumption and taking that, okay, this house is rented out, because we don't know whether the house is even being rented out or is being self-occupied. So first, there will be three situations. So let me give you the first situation where we feel that the house is rented out. Now, where there is a joint property and the house is rented out, you have to compute the income from house property as a one single property, and then whatever is the net amount, that has to be distributed in the ratio of the holding. So for example, if I'm saying 50%, and if let's say the rent received in the whole year is 12 lakhs of rupees, and you have paid 5 lakhs of rupees interest. I'm not talking about municipal taxes and the standard deduction, etc., but I'm just taking broad figures. So out of 12 lakhs, 5 lakhs of rupees you deduct, and 7 lakhs of rupees which are remaining would be divided between the two as 3.5 lakhs, which each of them will offer as taxable in their hands. So this is the first and the simplest way. Second is where it is a self-occupied property. Supposing they are themselves staying in this, and they are paying the 5 lakhs of rupees interest. Now the question is, if that is to this amount is to be taken as a deduction, the maximum allowance there is only 2 lakhs. So again, it will be divided as 2. There will be a self-occupied property for the wife, because she is the primary owner, and she will be able to claim the 2 lakhs of rupees. Now 50% is 2.5 lakhs. So therefore, the restriction will be only up to 2 lakhs. The deduction will be allowed up to 2 lakhs.
Okay.
The same way, it can happen for the husband also if he is a co-owner. But now there is one more complication that comes in, where he says that she says that the husband is having one more property and the wife is not. This is the first property for the wife. Now under the income tax, you have a choice of selecting which property is your self-occupied property and which property is your let-out property. So therefore, let's assume in the case of the wife, there is no option, because she has only one property, so she takes this as a self-occupied property. In case of the husband, if he chooses, he can select the other property. So say for example, this joint property is property A and the other property is property B. So husband chooses that property B is his self-occupied property, in which case, as far as 50% of the property is concerned, wife can claim up to 2 lakhs of rupees being self-occupied. The interest can be allowed as a deduction. In case of the husband, the other second 50% becomes a deemed let-out property. So there will be a deeming income to be charged over there. So let's assume that the deemed income of that is 1 lakh of rupees. So if to that extent, it will be considered as if it is a let-out property. So on that 1 lakh of rupees, he can get a claim of entire 2.5 lakhs. So after taking the income of 1 lakh and minus the 2.5 lakhs interest, he will have a net loss of 1.5 lakhs.
Okay.
So that's how it can be claimed.
Rupashri, that was a fairly complex question, like Pannkaj told you right at the beginning, and you have got a fairly complex answer. Let me simplify it a little for you. Let me just wrap it up very quickly. What Pannkaj essentially told you is this, that when you buy property in your name and when you claim tax deduction on it, you need to first identify whether the property, whoever is claiming tax deduction, whether the property is rented property, whether it's leased out or whether it's self-occupied. The laws on tax deduction are very clear and they differ for, how much tax deduction you can claim on self-occupied property is different from what you can claim on deemed let out or leased out property. So you need to clarify that, and also remember that once you have decided that this property A is self-occupied and property B is leased out, you cannot go around changing that. So what you have decided stays final. Once you have done that, then within the purview of the law, you can claim a deduction. So basically, you and your husband, both of you all need to sit down, decide how you're going to classify those properties, and then claim your tax deductions. Also, like Pannkaj pointed out, property A could be your self-occupied property, while property B, your husband could actually claim property B as a deemed let out property. That also is possible, right?
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.